Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 13th of October 2023 and here are the questions we will be answering today. What is Maruti's expansion plan all about? Why is India Inc. riding a merger-demerger wave? Which 5G stock is a better bet, Jio or Airtel? And what is Nobel disease? Initially trailing in India's SUV race, Maruti Suzuki hit the top gear and became a key player in the segment in a short span. The company has now unveiled an ambitious plan for expansion into the electric vehicle segment. It is also aiming to triple its exports by the end of this decade. So what is Maruti up to? Abhijit Kumar dives into the details of its expansion strategy and also takes a look at potential bumps.
Maruti Suzuki is set to take a giant leap into the electric vehicle market. Its aim? To become a major player in India's SUV and electric vehicle market. The company has recently announced its plans to spend nearly 1.25 trillion rupees to bolster its capital expenditure between FY24 and FY31. The figure is significantly higher than the company's capex expenditure of 27,538 crore rupees in the last 8 years between FY16 and FY23. Through the investment, the company plans to develop over 10 new models, including 6 electric vehicles. With a focus on developing its SUV segment, the company is hoping to regain its lost market share in the segment, which had peaked at 51% in 2019, but has seen a decline over the years due to fall in the small car sales in recent years. In August, Maruti Suzuki India Limited's or MSIL's chairman R.C. Bhargava had announced that the company is eyeing a good 45,000 crore rupees expenditure to double its production capacity to 40 lakh units annually in the next 8 years. The automaker has also set targets to expand sales channels, building service and spare parts infrastructure, R&D strategies for new vehicles, and most importantly, export capabilities. It is set to allocate nearly 80,000 crore rupees for the endeavor. This massive expansion plan comes on the back of Maruti's acquisition of Suzuki Motor Gujarat's stake from parent Japan-based Suzuki Motor Corporation in July this year. So, what is Maruti up to?
Maruti, as I see it, epitomizes what I would like to call the second mover advantage, or in certain cases, even the third mover advantages. There was a time at the beginning of this century when Maruti waited and waited as others, such as Tata Motors, Mahindra and Mahindra, to an extent even Hyundai, were running away with the diesel powered vehicles market, and Maruti did nothing. The same thing is now happening in SUVs. Some time ago, companies like Renault and Ford came in with affordable mid-size SUVs and they created a new market segment. Maruti did nothing. It did launch Brezza and S-Cross, which seemed like Maruti was still holding back. That is the lens you have to apply when you look at Maruti's capex figures. Maruti has now announced a slew of electric vehicles launches in the next few years. Maruti is making that investment to safeguard its fortress.
Analysts believe that Maruti has the advantage of an established customer base and a robust service network. This can give it a competitive edge. But how is the company planning to finance its expansion plans? As of August this year, Maruti held a substantial cash reserve of 46,000 crore rupees. It plans to fund its initiatives primarily from its cash reserves and additional cash flows from the new capacities. Maruti Suzuki is also planning to ramp up exports, aiming to strengthen its position in the international markets. In FY23, MSIL's total exports reached 2.6 lakh units, an 8.8% growth year on year.
Typically, if you look at any automotive company, when they are ramping up, right, they have two choices: either to ramp up slowly and wait to get economies of scale and wait until they get the market penetration to enable them to scale, or look at new markets, existing markets where they can increase their presence and use get to capacities of scale or to use trims or things like that, which makes their overall production cost competitive.
There are potential challenges as well. The transition to electric vehicles, as well as the massive expansion of production and services, may deal a blow to Maruti Suzuki's finances, especially in the evolving automotive sector.
The first number challenge is that would your products and your models be accepted by the consumer, right? And second, if you're across the whole space, will all segments grow at the same pace, or do you have to make an adjustment in your model mix? And the third is that there might be a regulatory challenge coming up in terms of the type of fuel or the type of regulations that will come, whether it's the CAFE standards or whether it is the safety standards or whatever it is.
Its strategic initiatives in the electric vehicle segment and international export market mark a significant milestone in the Indian automotive industry. Although Maruti Suzuki India Limited has a robust foundation to leverage, the challenges of technology adoption and global competition will test its mettle.
India's impressive economic growth is providing a smooth runway to car makers like Maruti. It is, in a way, also triggering the ongoing restructuring in corporate India. It seems we are in the season of merger, demergers, and splits. ITC, Vedanta, HDFC, RIL are some of the giants which have opted for restructuring. But why? We bring you the answer.
India's most valued company, Reliance Industries Limited, or RIL, approved the demerger of its financial services arm in October last year. It got NCLT's green signal in July this year. Mining giant Vedanta Limited is looking to split into 6 companies. The restructuring is expected to be completed in 12 to 15 months. ITC is demerging its hotel business through the establishment of a wholly owned subsidiary, ITC Hotels Limited. And it is not just India Inc. giants. Smaller firms too are restructuring. The Competition Commission of India recently approved the proposed combination involving the demerger of the FMCG business of Haldiram Snacks and Haldiram Foods into Haldiram Snacks Food. Corporate India, it seems, is on a restructuring spree. It picked up pace during the third quarter of this financial year, translating into $32.9 billion worth of such deals. This was the highest quarterly total since the HDFC Bank-HDFC merger announced in second quarter of FY 2022. RIL's $18.4 billion split of its financial services arm, Jio Financial Services, is the largest deal involving an Indian company this year. The merger of IDFC Limited and IDFC First Bank and the demerger of Jio Financial Services accounted for more than 60% of the September quarter deal value of $32.9 billion. Of the largest 5 deals this year, 5 were announced post-July. Vedanta Limited became the latest corporate giant to join the restructuring bandwagon. Analysts said the reorganization was necessitated by the massive debt of the promoter entity, Vedanta Resources Limited. Tata Steel, which is merging 7 group companies with itself, has said the amalgamation will integrate the steel value chain and ensure a common face to market.
Merger and demerger are critical tools for corporate restructuring. A demerger may be considered by a company when a business has reached maturity, or to discover value for shareholders. It may demerge and list it on the bourses. A demerger may be considered to tackle debt problem when a conglomerate wants to apportion debt to each of its businesses, and so that it can tackle debt. A merger, on the other hand, may be considered when a company wants to simplify its corporate structure. It may want to merge different, it may want to merge businesses in the same value chain.
When independent pure play companies are established, they are valued better as opposed to a company which has multiple businesses in it. The market would value it lesser than the sum of its parts, which is also known as a conglomerate discount. So to unlock value, it is sort of preferred that separate businesses which are not related to each other are carved out into separate companies so that they can be valued better.
Aided by the $57.8 billion merger of HDFC Bank and HDFC, India Inc. reported its highest ever mergers and acquisition in value terms in calendar year 2022 at $171 billion compared to deals worth $145 billion announced in 2021. Before 2021, the previous record was set in 2018 at $129 billion. Compared to 2018, the years 2019 and 2020 saw a fall in M&A deals in value terms. The recent restructuring trend caught up after a dull pandemic period. Towards the end of 2021, a report by consulting firm Bain & Company said that the appetite of Indian companies for acquisitions had increased after COVID. The report had said that the acquisition activity was expected to continue. In 2022, the financial services sector accounted for the highest share in total M&A deals, valued at $69.4 billion. Meanwhile, the high-tech sector accounted for the highest deal volume, with its deal value totaling $18.6 billion.
For instance, of late, you may have seen that in the airline sector, which is going through certain turmoil, you may see that certain airlines are demerging their cargo business, because they want to attract the right set of investors for the right set of business. Okay, it is quintessential because now private capital that is available, or the capital that is available in general, is also sector specific in most cases. So in order to attract right capital for that particular sector, businesses are restructuring such that the shareholder finds better value, better valuation, and they have very focused management for developing that particular company or that particular vertical within the conglomerate. So that is why they keep doing.
And what the road ahead looks like.
The Indian economy is on a high, so businesses are reaching maturity, and they may consider demerging business. The stock market is at an elevated level, so there will be a propensity by companies to take advantage of this buoyancy.
Right now, post-COVID, we are seeing a lot of restructuring that is happening in the market in various sectors. But in my view, this building of efficiency and building and restructuring the businesses will always exist. It is not a phenomenon that is cyclical, but it's a phenomenon that is constant.
This year may also see robust deal values and volumes being clocked as the profit of companies soars. But a lot will also depend on how the global economy performs. Mergers and demergers are usually driven by commercial needs, and as the economy grows, we will continue to see such restructurings.
A healthy financial market is also a reflection of India's growing might, and that of India Inc. too. Meanwhile, shares of Bharti Airtel claimed a fresh record high on October 11th, having outperformed the markets over the past 1 year. By comparison, shares of Reliance Industries have underperformed its peers and benchmark Sensex, delivering 7% return during the period. However, as India's biggest telecom companies fight tooth and nail to aggressively expand their 5G services, which of these stocks could charge up investors' portfolios? Nikita Vashisht takes a deep dive in our next report.
Thanks to 5G services, Reliance Jio and Bharti Airtel may corner 80 to 85% of revenue market share in 2024, believes Fitch Ratings. In an October 10 report, the agency said that the regulatory environment and risk factors have improved for the sector. While the future growth of wireless revenue will slow down, leading telcos will seek opportunities in non-telecom sectors. Following the report, shares of Bharti Airtel hit fresh record high of 961 rupees per share at the bourses on October 11. Over the past 1 year, shares of the Sunil Mittal-led company have jumped 23%, while those of Reliance Industries have increased 7%. By comparison, the S&P BSE Sensex index has surged 15% and the BSE Telecom index has advanced 22%. Analysts expect 5G focus to eventually drive ARPUs, or average revenue per user, higher for both the companies in the future.
In fact, if you take a closer look, you'll realize that they are more aggressive than ever in a bid to capture higher market share and eventually build a robust roadmap to much more enhanced ARPUs. Both are taking slightly distinct approaches towards the same objective, while Reliance Jio is focusing on cost leadership and is incrementally focused on improving coverage and enhancing indoor connectivity. At the same time, Bharti Airtel has been focusing a lot on improving its product and service mix and has been focusing on on creating a diverse basket of use cases, right from consumer broadband to enterprise. To it has also been looking at sectors like healthcare and agriculture.
According to analysts at GM Financial, Reliance Jio and Bharti Airtel are expected to invest about 75,000 crore rupees in the current financial year to strengthen their networks. Of this, Jio may invest around 42,000 crore rupees and Bharti Airtel around 33,000 crore rupees. That said, amid high capex intensity and no tariff hike, analysts see both the companies indulging in monetization of 5G services to boost margins and ARPUs. Jio and Airtel have touched 50 million 5G customer mark each, with ARPUs at 180.5 rupees and 200 rupees respectively. Against this backdrop, which stock looks better from investment standpoint?
While the initial investments might lead to lower cash flows, it's expected to be offset by incremental revenues as more and more users adopt the 5G services. Investors can consider holding on to these stocks for the future. The potential for increased revenues, expanding user bases, and leadership in 5G and 6G services make Airtel and Jio attractive investments.
According to Bloomberg data, the average target price for Airtel stands at 968 rupees, leaving 1.4% upside potential from here on. For Reliance Industries, the target is 2,974 rupees, up 19% from current levels. On October 13, Q2 FY24 earnings and wholesale inflation data will be on investors' radar.
He's making plans for an early retirement. Business Standard.
Let us now turn our gaze to a rather strange phenomenon known as the Nobel disease. What is it? Ayush Mishra explains.
The Nobel Foundation has just unveiled its latest laureates. While scientists and literary scholars receive numerous accolades, the Nobel Prize stands out as the most prestigious. Recipients of the honor are catapulted into lifelong fame and their lives undergo a profound transformation. They find themselves universally recognized, revered in various spheres of the society, spanning science, culture, and politics. However, an interesting phenomenon among Nobel Prize winners is occasionally they succumb to phases of excessive self-assuredness that drive them to think and behave in remarkably irrational ways. In private quarters, it is called Nobel disease or Nobelitis. The phrase, in a light-hearted sense, encapsulates the inflated ego and excessive self-confidence that comes with a Nobel Prize. The term Nobel disease does not refer to a medical condition or disease in the traditional sense. Instead, it is an informal term that is used to describe a trend among Nobel laureates who are sometimes found making eccentric or unconventional statements or engaging in unusual behavior in public. There is no evidence that Nobel Prize winners are more prone to critical thinking errors than other scientists. But this phenomenon suggests that being an authority in one field does not necessarily make one an authority in another. Canadian medical scientist Frederick Banting won the Nobel Prize in Physiology or Medicine in 1923 for discovering insulin. Later, he went on to combat cancer with limited knowledge, yielding no success. Did you know US researcher Linus Pauling, a double Nobel laureate, believed that high vitamin C doses could cure cancer? He was criticized for poorly designed clinical trials. More recently, Egyptian Nobel laureate Ahmed Zewail's ambitious project of developing a science and technology city in Egypt was seen from the prism of a Nobel disease in some scientific quarters. The reason? The project bore similarities to the actions taken by ancient Egyptian rulers and communist leaders of Russia's Leningrad. Nobel laureates are not immune to making unconventional claims or delving into unproven realms. To prevent this, it's crucial to have a realistic assessment of their abilities because prevention of this disease appears more feasible than finding a cure.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Economics Nobel winner Milton Friedman once said that he was asked about opinion on everything, from a cure for the common cold to the market value of a letter signed by John F. Kennedy. Well, that's all for today. For more news and analysis, please log into business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.